Picture this, the Goldman Sachs Group Inc., market cap $276 billion, a fortress on the skyline, net income $17.06 billion, operating margins 38.6%, revenue growth 14.50%, ROE 14.55%. That's soaring growth. Current ratio 1.50 times. Liquidity looks solid. Punters see endless compounding. Wall Street's envy. Trading desks humming. Investment banking fees rolling in. 14.5% growth? That's the dream. I've chased it myself back in the day. Margins fatter than most casinos. Net income stacking like poker chips. Trading volumes exploding post-earnings. M&A pipeline bursting. Equities desk printing money hand over fist. That's the siren song. Pulls in every punter with a pulse. Everyone's buying the narrative. Shares up steady. Analysts slapping buy ratings left and right. Cash looks like a war chest, ready for deals, buybacks, dominance. I sat in those city trading floors in '98. Felt invincible then too. Hype builds fast. On paper, brilliant. Wall Street's golden child. Punters piling in. Ha! But if you stop polishing the paint and check the engine, that's the pub talk I remember from 2008. Shine wears off quick. That's where the cracks start. Everyone's buzzing about the Goldman Sachs Group Inc. Fat profits, strong growth, cash pile 1.14 trillion, bigger than debt at 839.67 billion, rates at 4.36% on the 10-year, VIX 17.2, normal volatility, cost of capital restrictive, dealers used to hand out free money, zero rates, quantitative easing fire hose, banks swam in it, Goldman thrived, leverage didn't bite then, profits flowed free. Remember March 2020? Markets froze solid. Leverage players begged central banks for bailouts. Trillions printed overnight. Goldman navigated the chaos, but balance sheets bloated ever since. Scars run deep. But now, rates tripled since 2020. Feds hiking hard. ECB matching step for step. Bond yields screaming higher. 10-year Treasury 436. That's no joke for leverage players. Cost of funds jumps overnight. Margins feel the pinch. Volatility ticks up. Markets wobble. And firms like this, they feel it first. I've audited enough balance sheets post-zero era. The shift kills the addicted. Every time. But here's the murder weapon. Debt to equity 6.79 times. That's bleeding extreme for any firm. A towering 6.79 times leverage. Like stacking £6.79 of debt on every pound of equity. Remember that number. That's not a balance sheet. That's a house of cards in a gale. In my forensic days, 3 times leverage raised eyebrows. 4 times? Red flags everywhere. 6.79? Russian roulette with 5 bullets loaded. That worked at 0% rates. Lethal at 4.36. Put simply, borrowing costs just tripled. The dealer raised prices and punters still line up. And that leverage tower starts shaking. Debt piled on steady, from 700 billion to 839. Sounds manageable so far, right? Cash covers debt on the surface, but let's open the books, follow the money. I've seen this script play out 3 times in 20 years, ends the same way. Argument 1, the alibi. What the Goldman Sachs Group Inc. wants you to see. On paper, this looks rock solid. Margins 38.6%, ROE 14.55, growth 14.50%, current ratio 1.50 times. That's industry envy. Fat profits funding expansions, deals flowing, trading revenues booming, punters lap it up, compounding magic, buybacks on horizon, rates might peak, Fed pivots soft, growth sustains teens, cash deploys smart. Imagine perfect landing, soft pivot hits, clients flood back, fee pools swell massive, share price doubles from here. That's the dream they paint. Fair play. I've bought the hype before, got burned once, lesson learned. Liquidity fortress, net income 17.06 billion. Punters think, compounding machine. I'll give them that. Fair play. Best case plays out clean, no wobbles, steady wins. Best case? Rates peak here, Growth holds double digits. Cash funds buybacks. That's the alibi they sell. Wall Street echoes it. CNBC pumps it daily. But here's the catch. Peel back the shine. Check under the hood. Profits dazzle, but cash tells truth. I've dug enough ledgers. The divergence screams trouble. Always does. Operating cash flow minus 39.79 billion versus profits. That's a mirage. Profits on paper, cash vanishing. Working capital eats it. Receivables balloon. Payables stretch. That's no accident. Management timing it. In plain English, they're booking wins. But cash? Draining like a sieve. That's the first fingerprint. Your portfolio feels it. No real fuel, just smoke. That's the trap. Now, argument 2. The evidence. The twist. Here's where it gets proper dodgy. Remember that leverage number from earlier? Still towering. Cash 1.14 trillion covers debt 839 billion today. Looks safe. But equity? Razor thin at about 124 billion. That's the twist. You're leveraged deep on a skinny base. Concrete anchor on a swimmer. Rates grind higher. Cushion vanishes. Fast. At 4.36% rates? Interest bites 36 billion easy. Eating profits. Half the net income gone. Rough math on funding mix. Deposits cheap short term. Bonds pricier long end. True cost climbs. And with cash flow negative, you're bailing out bondholders, not shareholders. Bond coupons paid first. Dividends? Question mark. Retail chases yield, gets cuts instead. That negative 39 billion cash flow? Accelerating drain. Put simply, dividends at risk. Bag holder alert. Shareholders foot the bill. I've watched retail punters hold bags while execs cash checks. Happens every cycle. Short interest just 2.30%. Looks safe, but pros smell it. Whales positioning quiet. Here's where it gets ugly. The bag holder threat. High rate squeeze. Leverage amplifies every tick. 2 problems with the alibi. 1. Cash flow divergence shreds quality. Earnings fluff. 2. That leverage noose tightens. No escape. VIX 17.2. Normal now. Spikes? That stack crushes equity. 20 VIX? 30? Equity halves. Bondholders bail. You hold dust. We've been here. Ends tears. Every time. Now, argument 3. The smoking gun. The detail everyone missed. Absolute state of the blind bulls. Macro plus leverage equals crisis. 4.36% regime. No cheap money dealer anymore. Powell hawkish. Yields climbing. Debt 839 billion. Dwarf 17 billion income. Leverage? Visceral noose in volatility. One downturn. Trading desks bleed. Fees dry. Cash burn doubles. Price $936. PE 17.1 times. At target. But ignore the engine? You're paying premium for a mirage. Risk not priced. Downside skews heavy. Shorts 2.3%. Crowd blind. Smoking gun. Cash flow minus 40 billion. Leverage 679. Rates 436. Perfect storm brewing. Mark-to-market losses lurk. Unrealized hits incoming. Buried footnotes hide billions. One yield tick up. Books bleed red. One market wobble. Mark-to-market hits. Equity shreds. Bondholders paid first. You? Wiped. That's the trap. Higher the cap. Harder the gravity pull. That's the bit they hide. The higher the cap, the harder the fall. If you want this level of forensic breakdown on financial services every week, subscribe. Stay with me. We've seen this film. Right. Verdict time. Is the Goldman Sachs Group Inc. cooked? Not dead yet, but limping. Acknowledge the strong bits. Growth 14.5. Margins fat. Cash pile covers debt today. Trading sharp. Fees resilient so far. Not a zero tomorrow. Bull case has legs if stars align perfect. Rates cut quick. Volatility sleeps. Cash flow flips positive. Clients stick. Deals multiply. Possible. Rare as hen's teeth, but possible. We've seen soft landings. 93, 95. Bull case lives there. But that changes nothing. The rot festers underneath. The leverage tower? Still there. Unchanged. Lethal in 4% world. That noose? Tightens daily. Cash flow minus 39 billion? Mirage alert. no free lunch. Skeptic score, 11 out of 20. Middling. High profile 276 billion cap. Extreme leverage. Zombie vibes at these rates. Profits mask pain. Cash drain dooms. At 936 price? Fair value 947. But risk adjusted? Overpriced. Rolex price for a Casio with a noose. Downside protection 0. One shock. Shares halve. Been there. Done that. Lehman playbook. Bear Stearns rerun. The thing I'm watching. Operating cash flow when rates hold 4% plus. If it stays negative, equity grinds lower. Bond yields spike. Refinance walls hit. Dividends slashed. Buybacks? Dream on. Portfolio drag incoming. I've tracked 3 cycles. City firms. Wall Street giants. Pattern holds every time. No exceptions. I'll be tracking operating cash flow when Q2 earnings drop. Subscribe to catch that breakdown. Right, what's the damage? If you forget everything, remember the number. Stay skeptical.